Welcome to the weekly update, where I'll go over the action in the market for the week of October 28th through November 1st. And then we'll look at how things stand for the week of November 4th through the 8th. We had the second down week in a row. We've actually turned negative in the short term on the daily charts. We're below the 20 period moving average. We're still above the 50. So we're positive in the intermediate and long term. We're still looking positive here when we look at our bigger picture with the weekly charts. So we'll go through and analyze things and just see what we come up with. There's a lot of variables. We had a number of employment pieces of data that came out over the week, and they were stronger than expected until we got to Friday when we had the employment situation report that came in much weaker than expected. That has pretty much locked in the idea that the Fed will cut rates 25 basis points on November 7th. Now, the variables that are still out there is the election that's happening, and that's kind of tightening up a little bit. I have a few charts to show you where Trump was quite a ways ahead. Now it seems to be getting a little bit closer as we go through the weekend. But there's a lot of variables with that. Is there going to be something weird that happens before the election, during the election, and then after the election that could have an impact on the markets? Then 2 days after that, we have the Fed coming together, and it does look like they will cut rates, but what are they going to say at their press conference? So the market has a lot to digest right now. We have picked up with volume, though. Pretty much all week, we were above average with volume. So we're seeing a little bit more participation now. So just some notes to get through before I get into the actual meat of the video. The daily videos are where I do most of my analysis and commentary, and I talk about that again later. I have a number of weekly videos that I do, but they're all meant to tie into the daily video. I do have a PDF below this video that you can download, the slides and the charts. Sometimes folks find that helpful. I update pivot points every day on the YouTube community tab. Some of those apply for the whole month, and we just shifted over to a new month now. And then there are those that only apply to that particular day, and they can be really useful as areas of support or resistance. I have a private Facebook group, not really active. If you want to join that and maybe ask me some questions, have a little back and forth, you're more than welcome to do that. And then I really watch YouTube and Rumble comments. I don't get a lot of comments on my videos because I don't take a lot of opinion type stances. I just let the charts speak for themselves. So the comments that I do get, specifically on Rumble, they're garbage from social media experts, and I just go through and I delete those. If you have a legitimate comment, you are more than welcome to post that. And I do post to Rumble and YouTube, and they're kind of a backup to each other. Here is the link to the Rumble channel. Then I do have a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. There are additional videos there that I post. We go through trade ideas. I have courses that there's a basic course there now, but as I roll this out into 2025, there'll be a technical analysis course. There is a strategies course, and there's also what I call mental analysis, getting your emotions under control. And I go through all those things. One of the other things that you have available to you as part of the program is we can set up a time to talk one-on-one, whether it's by voice or Skype or Zoom or what have you. If you're more interested in that, you can send me an email, but if you want to find out more about the program, go check it out. There's a link that'll take you to the website as well as to a video that talks more about the program. One benefit is with the daily and weekly videos, you get immediate access to those right when they are prepared. And as I said before, the daily video is the real foundation. The weakness that we saw on Thursday this past week, we didn't really know it was going to happen, but it certainly didn't catch us off guard because our charts were telling us ahead of time, be aware of something. We're still looking positive, but we're looking vulnerable. And then boom, we ended up going down on Thursday. Now we did bounce up a bit on Friday, but we're still looking more negative in the short term for right now. And you would have found that out by watching the daily videos. Also, there's an additional video that's shorter that I go through that's on the website where I just go through the main charts, what I call primary indicators. And then I have some ideas there, things that you might want to consider as far as positions, both in the short, intermediate, and long term. So you may find that useful. Okay, let's go back and talk about the week session. So for the week, we were down 1.37%. That's 2 weeks in a row now. After having a nice long winning streak, now we've had two losing streaks in a row. We were above average with volume, so we're seeing that picking up. We are still positive overall. When you look at the long-term trends, even the intermediate-term trends, we're still hanging in there. We're just coming into a period right now anyway. Now I could shift over and turn more negative, but at this point, it just looks like short and possibly going into the intermediate term that we could turn negative for a while. But we're also coming into a period of positive seasonality. November and December tend to be good months. And from November through April in 2025, those are usually the best times of the year. There's no guarantee that that's going to happen, but historically, that is what has happened in the past. And then we'll be getting more information about inflation and interest rates, where the interest rates they've been going up. Now, the thing is, the market was all hot and bothered about the Fed coming in and cutting rates, and they did that by 50 basis points. And interest rates have pretty much gone up since then. It's like, okay, where's this honeymoon? Where's this Goldilocks, this soft landing that we're supposed to have? Ever since the Fed came in and cut rates, the market's kind of doing the opposite. Now, the stock market has held up quite well, but interest rates are going up to the point where it's starting to have an impact on stock prices. And then we did get some inflation readings. We'll get more in the upcoming week. That still seems to be under control. The geopolitical things, what's going on in the Middle East, the Russia-Ukraine thing, we've got the U.S. election that's happening. We're going to have some Fed speak this week because they're not only going to make a decision about rates, they're going to come out with their press conference and their statement. So there's a lot of things hitting the market in addition to this whole election. The condition of the trend, this is the same as what it has been. We're still positive on the weekly chart, but it's declining. It shows a weakening trend right now, but we are still trending, and that trend is positive. So just some bullet points here. It was a very busy week of earnings. We're kind of hitting the high point, and we had some major companies coming out with their earnings reports. We also had economic reports. And as I said, up until about Thursday, it was like, these reports are looking a little bit stronger than expected. And then boom, on Friday, we get the weaker than expected jobs report. And so the indices closed mostly lower. The S&P was lower and so forth. Mega caps and a number of different companies, those that reported earnings, they had mixed responses, where we had Alphabet, Google, and Amazon. They were both up pretty strong on the week. But then Apple, Meta, which is Facebook, and Microsoft, they ended up having losses after they reported on their earnings. Mega caps and semiconductors did underperform. This is the real strength of the market and the growth areas of the market. And if they're under pressure, then the index is usually under pressure as well. Not only for the S&P, but for the NASDAQ 100. Also, the Dow was kind of chopping around as earnings reports were released there. The economic reports that came out, as I said, were typically stronger than expected until we got the employment situation report, which was much weaker than expected. Interest rates rose. A week ago, we were at 4.24% with the 10-year yield. After this Friday, we closed at 4.36%, and the dollar is going up as well, and that's putting pressure on stocks. So for the week, the Dow was just down 0.1%. The NASDAQ was down 1.5%. That's where a large part of the mega caps are at. We also have mega caps and the Magnificent Seven stocks. Those are in the S&P as well. It was down 1.4%, where the small caps were actually up a little bit, up 0.1%. I've been showing this chart for well over a year and a half now. This blue line is kind of how we've been tracking with inflation when you compare it to 1966 to 1982. We still seem to be tracking going lower here. Even though this gold line hasn't been updated, we're still kind of following this path down. The reason I show this chart is because look at what happened after. Now, we don't know if that's what's actually going to happen. We just want to see, the way things are right now does not necessarily mean they're always going to be that way. Things can change after the election. What's going to happen? Is inflation really going to pick back up again? Or is it going to continue to go down, or will it go sideways? Then we're at 4.36% with the 10-year yield right now. That's above the 4.02% level. According to the Renmac research, when we get above 4.02%, that's when it starts to bite into corporate profits. And we're there now. So this has been updated. The number of unemployed for 27 weeks or over, that is continuing to go up a little bit. So we're seeing more of the long-term unemployed picture continue to advance. Then this is still looking good here, though. Earnings going out into the future. Now, I don't go on the percentage basis, and I have some other things that talk about that later. How much is it growing? Is it more than expected, less than expected? The takeaway from this chart is that we're still going up and to the right as far as earnings are headed into the future. Then we had the ISM manufacturing, and I'm going to show this in Tuesday's daily video because I already did Monday's daily video. This is manufacturing. The takeaway from this is that we were below 50. That shows contraction. Then in the upcoming week, we're going to get the services index that'll be coming out. And that has typically been over 50. We're seeing growth in services where we're seeing a contraction in manufacturing. And when you pair that up with the purple line, which is the S&P, this is actually going down. It's like, okay, usually they tend to hang out and go in the same general direction. We're seeing a divergence here. What's going to give? Are we going to see the purple line, which is the S&P, going down, or are we going to see manufacturing turn and go up, or a combination of the two? But this is a little bit concerning because they're going in opposite directions right now. Then historically, gold positioning tends to rise during periods of uncertainty as investors seek safe havens. Yeah, it's the lingo for that is gold is a hedge against insanity. And so we're seeing a lot of people getting into gold with all of the craziness going on in the world and the uncertainty at this point with the election and not knowing how that's going to turn out. That's why we're seeing a lot of folks really getting into gold. And then since we had the employment situation report, we come up with the all employees temporary help services where we're starting to turn back down again. Now, this was showing some improvement. When we drop below this red line here, that's often the last number of times that has come before we've gone into a recession. We dropped below this red line, but to date, there has been no recession. We still don't know if that's going to happen at some point or not. And as I continually say, there are charts that support we will go into a recession. There are charts that support that we won't go into a recession. The market is still betting on this idea of a soft landing, meaning that we're not going to go into a recession. This is one of those charts that's showing a little bit of concern as this red line is coming back down. And then total returns for a selection of major global financial assets over the year to date and October. And they switched them all over to US dollars, where silver, gold, they've been doing about the best. Here you have the Hang Seng there, that's international NASDAQ. The S&P still doing quite well, up over 20% when this was generated. And if you want to pause this and just kind of look at these different assets where we have oil, energy, they've been under a lot of pressure, and bonds, that's German bonds right there. And so some of the bonds have still been under pressure where we're seeing a real rise most of the time, or on a basis here of percentage returns. Silver and gold have actually been doing better. Then annual earnings growth. This is 2023. Then this was the estimate for 2024, and then going out into the future. Again, we're seeing this coming down, but they're still positive. And these will be adjusted all the time. And you have Microsoft, NVIDIA, Amazon, Google, Meta. And then that's compared to the median here. That's the dark green, where these are the big companies. And that's why we follow these companies. I don't trade them. I don't do positions in them, but we watch them because they have such an impact on the S&P 500. FactSet, they're really busy right now. This is showing that reporting with the earnings, they're showing at least 12% for the second straight quarter. That's over here on the right. It's down from what it was before, but still looking pretty healthy overall. Then they had another update of earnings here. As of Friday, 70% of S&P 500 companies have reported, and 75% of those that have reported, they're above their estimates. And they tend to lowball this. There's some manipulation going on in there. So when you take it all together, they're 4.6% above the estimates right now. So not great, not stellar, not better than we've ever seen before, but still looking pretty healthy. Okay, here's the intraday chart where we had Monday, kind of a sleepy day. Tuesday, we ended up opening lower and then closing higher there. Saw a little bit of sell-off going into the close. And things were pretty calm on Wednesday. So we didn't have any economic reports on Monday, and things were pretty sleepy in anticipation of economic reports coming out on Thursday and Friday. Well, then we had the Thursday reports. Now, this is not necessarily driven by the economic reports. The futures actually turned weaker during the night and then just got weaker after we opened in Thursday's session. But we came all the way down. This was a pretty big down day, especially when you compare it to what we've been seeing lately as far as market movement. And this is what switched everything over to negative. Then on Friday, we tried to bounce back up off of that. You notice right down here where it says S4, that's right about where the 50-period moving average is. And we were able to bounce up off of that. The futures were strong. All the economic reports came out, but the market really didn't react to those. We started to really go up higher, but then kind of fizzled out, drifted down, and then ended up closing at this dark blue line, which is called the daily pivot. So we gave back a lot of those gains, and we really didn't improve the situation as of Friday. So for the week, and this is just the 5 trading days of the week, all the indexes ended up being down, with the NASDAQ and S&P being down the most. We had the Dow being down the least. Now, these are different than the numbers I just talked about. These are just the 5 trading days, not Friday to Friday. So going back to the beginning of the year, though, we have the NASDAQ 100 in second place, followed by the S&P, and all of the other indexes are positive year to date. The sectors, we had a down week, so I sort this according to what was down the most. Real estate, and they don't like that interest rates are going back up. That makes mortgages and borrowing and refinancing and all that stuff more difficult. So they really got hit. Utilities, which had been really strong, well, now they're seeing some weakness, and they were down this week as well. Tech took it a bit on the chin. We had the financial sector, which is still holding up well, and communication. And a lot of that had to do more with earnings and things that are coming out. That ended up being positive. So then on the next chart, what I do is over on the right-hand side, there's a thing called the Scooter score. And this just ranks that particular sector on a scale of 0 to 100, where we have communication, financial, and discretionary. They are in the top areas. They're above 90. And discretionary really benefited not only from Tesla's earnings that already came out, but then we had Amazon coming out with their earnings, and Amazon was up over 6% on Friday. So that really helped this particular sector, where we have energy is still the weakest performing sector. So looking at just the 5 trading days for the week, we had communication, discretionary, healthcare, and let's see, financial, staples, energy, and industrials were up. But then we had tech, real estate, and utilities, where utilities had been strong. Now they're seeing some weakness currently. Going back to the beginning of the year, communication, financials, utilities are positive the way that it's measured here. All of the other sectors are negative, with energy leading the way lower. Here's the relative rotation graph, where we're seeing a lot of moving around here. Utilities, real estate, they had been some of the stronger areas. They're seeing some weakness now. Now, this goes back over the last year, not just the last week or the last month. So we're seeing some weakness developing there. Seeing a little bit of improvement with the financials. That's been a stronger area. Also, with discretionary, and with Tesla and Amazon being a huge part of that sector, seeing a bit of an improvement there. Also, the industrials, that's more driven by what's happening with the economy. Where we're seeing some improvement here with tech, it had been quite weak. Now it's showing some improvement. It's turning blue. Then you have materials showing a little bit of improvement, and then communication as well, where when you look at staples and healthcare, these are defensive areas, and they've actually been showing some weakness lately, with energy still looking the most negative. Here's what it looks like more in a spreadsheet type of format, with the financials, discretionary, industrials looking the best. Then we hit into this blue area where we're showing some weakness but improvement with tech, materials, and communication. The more neutral areas showing some weakness as well, real estate, utilities, and then the negative areas would be energy, healthcare, and staples. And if you're more positive on the market, having healthcare and staples not doing as well, because those are defensive areas, that's actually more positive longer term for the market. Just looking at the different major indexes, you see how utilities had been really strong and just comes way down here. Seeing a little bit of improvement with the S&P 100 and S&P 500. The Dow just coming off of an all-time high a week ago. We're seeing a little bit of improvement here with transportation, which is really chopped sideways for 2024. The mid caps are showing a little bit of improvement. Still negative, but showing some improvement over the last year. Also is the NASDAQ 100. Here's what it looks like more in a column format with the composite average looking the best. Transports and mid caps showing some improvement. More neutral would be utilities, the S&P 100 and 500. And then still negative over the last year would be the NASDAQ 100 and the small caps. Okay, sentiment. Had the latest reading from Investors Intelligence coming in at 2.69. That's neutral to us. We really only pay attention to this if it gets above 3 or below 1. And here, we actually saw a switch just within the last day or so. When I showed this, or when I did this video a week ago, Trump was up by like, I don't know, 10, 15 cents or something. We're actually seeing Harris coming back and going into first place here. That's on a site called predictit.org. It's where you can bet on these things. I don't actually do that, but I follow this just out of interest. Then I found another site called Kalshi.com. I don't know if I'm saying that right. But Trump had been pulling away up here. Harris had been declining, but now we're seeing them come a little bit closer together as we approach the election. So this previous chart has Harris in the lead. This still has Trump in the lead, but it could be weakening right now. Then, not to be outdone, Bloomberg came out with their thing, says Trump's lead over Harris on the prediction market, and that's what those charts that I just showed you are from. It narrows. So it had been starting to break to the upside where Harris was breaking to the downside. It's coming back a little more even. Now, this is, who knows what's going on with all of this, but it's just kind of interesting to watch. Okay, as far as where are we with sentiment right now, we came in at 49. A week ago, we were positive. After Thursday, we actually dropped down to negative. Then with Friday's bounce, we came back up to 49. So just to show you the historical chart, and we came up to that 75 level, and then we stayed there for a little while, for a lot of October. Then we really started to drop. We dropped below 50, but a little bit of a bounce in Friday's session. Active asset managers, not really extreme right now, coming in at 82.53, which is what we're seeing right here. So not really an extreme reading that way. The VIX is still up over 20. It was over 23 after Thursday. It's now up over, what is this, 21, 22? It's really hard to see these numbers. But anytime we get above 20, that's when we get concerned because that's when we tend to see negative annualized returns. And we have the S&P just coming off of setting an all-time high, and we're still getting very high VIX readings. That we don't usually see that. The VIX is usually really, really low when the S&P is hitting all-time highs. Here's a seasonal chart. This has been updated. We probably are coming back up and matching this now that we're getting into November, since we're getting very high readings with the VIX. But this is looking okay, even though it's turning back up a little bit. The longer term trend here, when we compare cash with the tech sector, when this is going down, that means tech is outperforming. And we're still doing that, even though we saw some recent weakness here. The RIDEX bear bull ratio, folks, are still bullish overall. Now, this is as of Thursday, so it doesn't take Friday's action into account, at least yet. The ulcer index, we're still below the moving average. Now, we've started to go above the moving average on the daily chart, showing that fear is picking up slightly. Not really a concern here. We look at the spread between risky and not as risky options. We're still getting a very, very high reading on this chart, which means if you invert it back to how it usually goes, that would be a very low reading. That just means there's not a lot of fear in the bond market with all the craziness that's going on. We did get the latest reading from the American Association of Individual Investors. Not much of a change. We're coming in at 8.5, 8.6 here, but the moving average is still continuing to go up. We're seeing this going up as the VIX, which is daily, and then we take a 3-month average of the VIX and do a ratio. When this is going up, that just means the VIX is going up more now than the 3-month average of the VIX has been. And that's been, it's hard to say whether that's positive or negative. So we're not really getting a lot of insight from this particular chart. This is still positive. We look at a 253 period moving average, and those are the number of trading days in a year of the equity put call ratio. And this is going down, which is still doing, is positive for the market. Looking at the economy, we're still under the black line with the financial conditions chart. So that's not a concern. The latest reading from GDP now comes in a little bit under 3%, according to the range of forecast, a little bit under 3% to the upside and what, to 1 3/4 or so to the downside. And we did get the first reading of GDP for the third quarter. And so now we're starting to get estimates for the fourth quarter. And the takeaway here is that we are currently positive right now, because one of the ideas of a recession is that we have negative GDP for 2 quarters in a row. We did get this updated, the real-time SOM rule recession, where we had gone all the way up to 57 and the market was just freaking out about that. We've now dropped back down below this red line and coming in at 0.43. So that doesn't seem to be a concern, at least right now. The smooth U.S. recession probabilities, we had come close up to this black line. We're actually dropping back down. So according to this, they're not necessarily anticipating a recession. And this hasn't been updated since the end of September. The Brave Butters Kelly leading index is still going down overall. The last time this was updated for us. Inflation now saw a little bit of an adjustment after we had the core PCE coming out. And we still have yet to wait for the CPI to come out. FedWatch, 98.9% chance that they're going to cut rates 25 basis points in the upcoming meeting on Thursday. We're getting an announcement a day later. They pushed that back because of the election, since Tuesday's election day. And we're pretty much locked into that. And the weaker than expected employment report on Friday pretty much has that as a certainty right now. Looking out to the December meeting on December 18th, there's an 82.7% chance that they're going to cut rates another 25 basis points at that meeting. And seeing that a little more convicted right now based on what we saw this past week. Fed balance sheet still continues to go down over on the right, but it goes up when you look at the numbers. And then the year over year, it's going up over here on a year over year basis, where we're actually seeing a bit of a decrease year over year. Keeping an eye on the overnight reverse repurchase agreements, not really seeing all that much right now. So looking at the weekly chart of breadth, we did come down a little bit, but we're still above the advancing moving average based on price and volume. Seeing a real contraction of the new highs, a little bit more of new lows here. So we're going down with the 4-week and the 10-week moving average. Coming down after being extreme positive with the advanced decline ratio, we've turned negative now on the daily chart. Accumulation distribution, also negative now on the daily chart, just coming down closer to the moving average, still looking positive here. As far as the trend, still weakening because we're below the moving average and we are declining with the dark black line here. That's the ADX. We're getting really close to that 20 level. And if we drop below 20, that means we're not trending. Even though the green line's coming down, it's on top with the red line going up, but it's still on bottom. So we are still positive here. And we saw a bit of a drop off, but we're still positive with the Erin indicator. It's been flatlining on the daily chart, but it's still positive there as well. Mass index not generating a signal right now. So looking at a daily chart where we came right down to the 50-day moving average, and so far that level is holding. That means the intermediate term trend is still positive. And we're negative in the short term according to the Keller market model. We're still positive in the intermediate and long term across the S&P, mid caps, small caps, and NASDAQ 100. So looking at bonds, we're negative based on price in the short and intermediate term. We're negative with commodities in the short and long term. We're negative with the dollar in the long term, but now have turned to positive in the short and intermediate term. So we're looking at this long-term trend channel here, coming down a little bit, but still well above the midpoint. Still above the 50-week moving average, even though we did pull back this past week. And we're still coming down a little bit, but way above this R2 pivot level right now. So even though we've seen some weakness, the longer term picture is still looking positive. We pulled back here, getting a little closer to the 13-week moving average, but we're still looking more in an uptrend and getting extreme negative with the McClellan oscillator. We're also seeing that on the daily chart. And this could still go lower than where it's at now. But if this starts to turn and go up, that could end up being more positive for the market. Bullish percent index, seeing the same thing that we're seeing here on the weekly chart. We're coming down after getting an extreme reading. So that's negative since the movement is obviously down. But we're not officially negative unless we drop below 50. But we are negative because of the direction that it's going in. We bounced up a little bit with the Swenlin trading oscillator based on price, a little bit of a tick based on volume, but both of these are still below zero. So this chart is negative. And coming down with the summation index after being extreme positive, and we're coming down on the daily chart. We're also declining based on volume, not only here on the weekly chart, but also on the daily chart. Starting to drop below the midpoint based on price with the PMO, even though the PMO is trying to come up. See how we've been jagging around here lately as the market's been really indecisive longer term even. We also saw a decline here, but we're still above zero based on volume. Coming down with the percent B indicator, but not getting an extreme reading currently. Coming down also with the PMOs that are rising, also declining with the buy signals and now declining with the PMOs above zero. And we're kind of all over the place here when we look at momentum, trying to go up in the short term with the slope oscillator, kind of flat with the TSI. Those are short term. Rolling over now with the MACD, kind of on top of the moving average of the PPO and PMO, trying to still turn up here with the Trix and KST, which are longer term oscillators. So a real mixed picture right now. The chicken money flow, which has now turned negative on the daily charts. We're also seeing some weakness here on the weekly chart. And the chicken oscillator's already gone extreme negative. It's down to this pink line where it's just declining here. So we're still above zero, but we are declining now. The force index went negative, then positive just in Thursday and Friday sessions, but we are seeing some weakness here, but it's still positive for right now. Declining, but still above 50 with the money flow. Since we had a down week, our rate of change for 1 week is negative. And coming down from the 50 period rate of change after we had been above this red line. But the context now is that we're going down. And coming down, but still above 50 with the RSI. After being extreme positive, the Stochk RSI is now dropping below the midpoint. And then here is the special K, and we're almost ready to cross over positive with this, believe it or not. It's been a long time coming. We'll see if that can continue if we see more weakness here. And still a little bit extreme positive with the Williams percent R. That's showing good longer term momentum, even though that momentum is now showing some shorter term weakness. And coming down after being extreme is the ultimate oscillator. The vortex, we actually went up a little bit where we've crossed over negative now with the red line crossing above the green line on the daily charts. Copy curve, just rolling over a bit here, but still a little bit positive where we're negative on the daily charts. And we came all the way down to this 10-week moving average, which pretty much equates to a 50-period moving average on a daily chart. And so this area of support for right now is holding. Now, if we break below that, we may come all the way down to this 40-week moving average, which equates to a 200-day moving average. Then looking at the trend with the Heiken Ashi, turning a little bit more negative with the dark candle. We're still positive here. The Kegi is black, but now it's pointing down. The Renko chart is still positive, and we're turning a little bit more negative with the 3-line break. And we actually went up a little bit with the ease of movement, so we're still positive here. Didn't see anything new with the point and figure chart. We're still working off of a triple top breakout that was generated on the 16th of September. And then seeing a little bit of weakness here with the PPO going down in the long term, declining in the intermediate term, actually dropping below the midpoint in the short term. And we've gone from being positive to 2 weeks in a row now being neutral with the Elder's Impulse system for the S&P. We have switched over to negative on the daily chart with the parabolic SAR. We are still positive here on the weekly chart. Then looking at the S&P coming off of a recent all-time high, the mid caps also a recent all-time high, the small caps just kind of chopping along sideways. The Dow came down, but still above its 13-week moving average. The NASDAQ also, even though it's seeing some weakness, is still holding up for right now. The NASDAQ 100 also still holding up, even though it was down. Here's a weekly chart showing the red candle. That means we were down on the week. The mid caps, also some weakness, but still above the 13-week moving average. Small caps coming right down to their 13-week moving average. The NYSE, after recently setting an all-time high, is coming back to its 13-week moving average. So we see some support, potential support, setting up here that the market tried to bounce up off of Friday. We'll see if it can continue in the upcoming week. The biggest software companies are still in a pretty solid uptrend, and they were up on the week. All stocks coming down, but still above the shorter term moving average here. The FANG index still above its 50-day moving average. ARC still in a downtrend here on the weekly chart. The Wilshire coming down, possibly testing this 13-week moving average. The banks are still looking pretty good, though, even though they were down on the week. The KBW ended up being up 0.5%, but we saw some weakness in the financial sector. You look at the MACD, the momentum is still positive. And now we're in the month of November, where we tend to be up 80% of the time, going back to 2020 with a return of 4.9%. And here is traditional Dow theory coming off of the high with the Dow, the transport still going sideways, and now we're seeing some weakness in the utilities. Then we look at the broad market here, the CRB index, weekly chart, coming down, and we're seeing a little bit of weakness here. They were down on the week, but we're still seeing a recent death cross with this longer term trend. Oil, really not reacting to what's going on all that much in the Middle East. Still coming in under 70 right now. The dollar still continues to go up, even though it's in a downtrend, both on the daily chart and on the weekly chart. So we're getting back up into that 104 range. And here's the dollar is poised for its best month since 2022. I'm not into this since whatever, because it's like since yesterday or something. But the dollar's been strong lately. But based on the moving averages that we use, we're still in downtrends on the daily chart and weekly chart. Gold coming off, it was setting an all-time high earlier, but ended up being down on the week. And silver also saw a pullback of 3.5%. Copper still in an uptrend here. So that's still suggesting that the economy is looking okay going forward. If you just witnessed a pause right now, I had to pause the recording, so I will continue. So let's go looking at bonds and interest rates right now. So we are still positive when we look at the long-term price of bonds here with the total bond ETF, even though we are pulling back and we've fallen under the 13-week moving average. But even though stocks were under pressure this week, with the monthly chart, stocks are still outperforming bonds. And you can see here where from all through the spring and into the summer, interest rates were really coming down. The Fed comes in and cuts rates, and now they're going back up. All right, and here's the weekly chart where we're seeing a real rise in US rates and UK rates. Also, we see German rates going back up, but we're seeing a little bit of a decrease here with Japanese rates. We look at some relative studies of different markets. First, we look at the intermarket analysis chart going back to the beginning of 2024, where gold is still performing best, even though it's been coming down the last day or so. Stocks are still in second place. That's the black line. Oil has been chopping all around, but it's still up on the year. Green, that's the dollar, where it's positive, but now we continue to be negative with the price of bonds year to date. Then we look at the ratio on a weekly chart between the NASDAQ 100 and the S&P, where the NASDAQ 100 is still underperforming, and we're even in a downtrend with this ratio. But both are still very close to all-time highs, even though the NASDAQ 100 hasn't hit an all-time high since July 16th. The S&P 100 is still, for the most part, still outperforming the S&P 500, and those are the bigger stocks that make up the S&P 500. Growth is still outperforming value, and that's what we want to see in a more positive environment. And gold is going up a little bit here. It's in an uptrend when you look at this ratio longer term, but for most of 2024, we're not really seeing this breaking out, even though a lot of people are now chasing gold, and that's kind of in favor these days. Even with the dollar going up, we're still seeing gold going up even more, and that's why we're seeing this ratio going up. Low volatility stocks, we're seeing really close to a golden cross here with this ratio when we compare it to the S&P, but overall it's declining, and lately it's been declining as well. If this continues to go down, that would be more positive. That means the S&P is outperforming the low volatility stocks, which are usually more defensive when we get ready to go down. Discretionary, seeing a real improvement with Tesla and Amazon doing a bit better. They're outperforming staples, even though we're in a downtrend when we look at discretionary to staples on a weekly chart. Bonds continue to underperform stocks on a weekly chart. Energy is still underperforming tech. And small caps continue to underperform the tech sector as well. Then some longer term charts here. The NYC breadth thrust coming down, showing a little bit of weakness, we're still working off of the long-term signal that was generated way back in October of 2022, so over 2 years ago now. Nothing new here with these WAG NYSE breadth thrusts. Still seeing some recent signals that had been triggered, but showing some weakness as of late. The long-term chart going back to the 1987 crash, the weekly chart here, the S&P 500, even with our recent declines, we're still looking good. And here's a further blow up of that, just showing how we're still well above the longer term trend line. And we saw a little bit of weakness here with the Zahorchak method. It was on a full on buy signal. That means we were getting a reading at 10. With some of the weakness and sideways action that we've been seeing lately, we actually had this tick down to 8. That's still a buy signal, but not a full buy signal right now. Look at the NASDAQ 100 weekly chart, coming down, but still above this trend line going back to 2009. The NASDAQ to Dow ratio is still holding up well. That's positive. We're seeing a little bit of weakness when we look at the NYSE new highs, new lows. Now, this red line is a 50-period moving average of the daily chart, but we're still above zero overall. So longer term positive, shorter term, we're pulling back. This is the same thing, but it's looking at the S&P 500 new highs minus the new lows and then a 50-day moving average. Also coming down, but still above zero, so it's still positive. And then we look at the Qs to the small caps, still coming in right around this blue line. That means that the NASDAQ 100 is holding up better than the small caps. We're also keeping an eye on the 3-month yield, just in case it really starts to drop the way we saw it back in 2007 into 2008. Then we have the cumulative new highs, new lows for the NASDAQ starting to turn up after years of declining. Now we're seeing some improvement here. But down here on the daily chart, you can see we've actually dropped to negative. Seasonality, and I have a number of different seasonal charts to show you. I had been showing this in the daily video. Now I'm switching it over here to the weekly video. When we look at November through April, the average percent change is we're up 7.1% and we're up 77% of the time. That's not 100%, but the odds are definitely in the favor of the market being positive. Then I adjusted this red square here now that we're coming into November, where seasonality during an election year going back to 1950, we do see some positive seasonality here. Also, November tends to perform well on a seasonal basis going back on a monthly basis to 1950. Then looking at the world, taking all the world together, where November tends to be a more positive month. And now we're shifting over into November and December, where going back to 1928, we tend to see positive returns going into the end of the year. But that's not automatic. Then here, looking from November into January, this tends to be a positive time for the year going back to 1928. It's up 65% of the time here. And then here's the whole fourth quarter, where the fourth quarter tends to be positive, up almost 80% of the time. And here's a Carson chart showing how stocks typically perform during an election year going back to 1950. Now that we're into November, we do have some potential positive seasonality. But then this is kind of a funky chart because they're taking a median here. So it's like the middle from 76 to 2023. The market actually has a tendency to outperform in a non-presidential election year, which that kind of goes against the conventional wisdom that election year, we have to be up. It actually underperforms when you look at this chart. And we're right here where the line is, that's when the election happens. So this weakness that we're seeing is not necessarily a surprise. We do see some positive seasonality, but it still underperforms the non-presidential election year. And the first half of November performs well, but a little bit better is the second half of November. Again, a median measure going back to 1950. Then we're into November now, no matter how you look at it, whether it's since 1950, the past 20 years, the past 10 years, or during an election year, November tends to be positive there. And then looking at November, December, and January, these are typically the best 3 months here that we have. And then we're up 11 out of 18 times in November during an election year going back to 1950. We're down 7 out of 18 times with a return of being up 2%. So thank you. I'm sorry about that little gap in the middle. I hope you have a great weekend, and I will talk to you in the next video.